Welcome to the Voice of Insurance. I'm Mark Gagan. Regular listeners will remember that episodes 2 and 3 were focused on the 1st of January reinsurance renewals. Now, obviously, it's not too late to check them out if you haven't already listened, but by this stage in the year, many of you have probably been saturated with all of the reinsurance reports and bombarded with all of the statistics. So now one's out of the way, it's time to be looking ahead to the significant renewal dates of the 1st of April, the 1st of June and the 1st of July. Market watchers will know that the 1st of April is all about Asia and especially Japan. The 1st of June is Florida, and July and mid-year is the big casualty treaty renewal time, particularly in the US. The reinsurance market has a lot invested in these renewals and has high expectations of pricing change because Japanese Typhoon has been incredibly active in the last couple of seasons and loss development has taken everyone by surprise. Florida has been busy developing its losses of 2017 and 2018 in new and surprising ways. And of course, tension has been building in the US casualty world as original rates have moved sharply upwards and reserving trends and claims trends have been coming increasingly under the spotlight. So there's a huge amount to play for in 2020. And that's why I was really lucky to catch up with Steve Arora, who's the CEO of Axis Re. I caught up with him at Axis' fantastic new London offices in the shiny and angular new skyscraper in the building opposite Lloyd's, known colloquially as the Scalpel. Steve took up his post at Axis Re just over 2 years ago. And to give you an idea of a kind of hint at the scale of those operations, Axis Re wrote $3.2 billion of gross premium in 2019. In our talk, we focus on all the big 2020 renewal seasons I've just been talking about in a lot of detail. But to set the scene and put him at his ease, I started by giving Steve a loosener question. I asked him to tell us a bit about himself, his career to date, and tell us where Axis Re fits into the global reinsurance marketplace.
Thanks, Mark. I guess just a word on myself. Been in the industry for my entire career. Haven't worked at many companies, but I have worked in many job families. So I started in risk management and in finance and ultimately made my way to the front end of the business. And I've worked in several different markets. So I've had the opportunity to have a generalist career path. And I've been with Axis Re for a little bit over 2 years now.
And Axis, where you're in the top 20 reinsurance players, but where do you want to play? Presumably, you don't want to kind of mix it with the Swiss and Munich of these world.
Well, we want to be a top 10 global reinsurer, and according to the way we look at and analyze the market, we consider ourselves to be around a number 11. Because we measure really the global players that are out there. We take out some of the national replayers and we look at P&C only and external sessions. But nevertheless, this is not about premium. And if we're number 9 or number 8 or number 12, in the end, that's not what's important. What's important is that we have the necessary strength and the reach to solve our client needs. And it's a really interesting question around what do we want to be. I think one thing that Axis did really, really well from the beginning of time was not to focus only on one product or another, but to have a very broad offering and to really establish itself as a global player, 18, 19 years ago. So we like to be a global player that has a broad set of capabilities that can solve our clients' needs. And ultimately, if we can do that in a way that wins for us and wins for them, our aspiration is to be more meaningful to the industry so we can add more value.
So you have pretty big ambitions. So it's not just a niche player, it's global, it's a bit of everything, and you want to be relevant to your clients sort of wherever they are and whatever they're doing, really. Is that right?
Yeah, I think that's a nice way of summarizing it. At the end of the day, we've been really strong as an expert-driven company that has been very technical, but also has the agility of a medium-sized player, and we want to keep those intact. But the path that we've been on over the last 2 years has been, how can we do more? How can we be much more effective with clients? How can we be hungry and active? And that's really one of the key ingredients to our strategy going forward is really leaning in with clients and making sure that we're effective, so we can match that technical expertise, that agility, with really good relationships and partnerships in the future.
Right. Okay. Well, I think that's probably enough about Axis. That's really interesting. But what's so interesting right now is the state of the market that we're in reinsurance. If we can maybe we've probably heard a lot about 1/1, but if you kind of sweep that away, and mentally everyone's much closer to 1/4 than we were to 1/1. We've kind of moved on. Give us a bit of a flavour about what's coming up. How's it been for Axis? Obviously, I've just seen your Q4 results. GWP was up 19%, if I'm right, in Q4, and your net was up 22%. So presumably you're quite happy with the way things are going. You're writing more, or how much of that was actual rate and how much of that is just volume?
Well, Q4 is not a big renewal cycle for reinsurance, so we're talking about pretty small numbers. And you have a mixture of many different things going in and there.
I'm just being a typical journalist, just reading too much into.
No, but you captured the right headlines. I'm impressed. No, but you have a little bit of rate. You have a couple of new deals that we were really excited about, and there's a few things. There's some timing issues, which doesn't make the comparison like for like. But before I talk about what's coming in the market, if I can just try and talk about the market overall in terms of context, I think it's important. And, we all know that the market is on the right trend, but the reason for that is the reinsurance sector has suffered from this unnatural phenomenon of unsustainable rates. And I think overall what I'd like to say is that I don't think the sector can add its maximum value until rate adequacy reaches acceptable levels. And maybe I can say a little bit more about that. So we all know that the market's fundamentally changed. Price equilibrium over time was decreasing because we had a steady increase in supply, and demand, you can say, was fairly flat to stable. But if you look at the numbers, the reinsurance sector is around $585 billion, with a steady increase of 3 or 4% per annum over that period of time.
In terms of that's capital available, or is that
capital?
That's capital.
That's capital, and that's both traditional and alternative markets increasing over time, despite record loss activity in 17 and 18. Now, what 19 has done, it's made it very clear that the sector overall has a global profitability issue. And so you can tell immediately that the tone has changed. And, supply, while it's been growing steadily over time, is probably set to stay flat or contract when it's all said and done. And by the way, I just want to make a note here about supply. A strongly capitalized reinsurance market is a good thing. And the reason why is it allows the private sector to solve society's needs when things happen. And so, yes, we're going to talk about profitability during this conversation, but I also am an advocate for a strongly capitalized market because at the end of the day, that's good for everyone.
So what are we going to do? You're saying that rates, we've got a profitability problem. That implies that rates are not adequate. They're going to stop. You're implying that they're moving in the right direction. But
yeah.
With this record capital, how is that going to add up in the end? I mean, how long? For one, how inadequate are rates at the moment? That's probably one conversation. Let's go into that first. I mean, how far off? How many years of hardening do we need before we get back to the point where your actuaries are happy with you?
Well, it's hard to predict, as you know, and every company has their own view of risk. But with an overcapitalized or a strongly capitalized market, the only way the reinsurance sector will move is if we transition to being a more disciplined market and becoming an underwriter's market. And that means we all need to be prepared to walk away from business when it doesn't make the grade, and that's when things will change. And I think there's two important points to make on why there's an importance of a market correction. The value add of reinsurance to clients is risk management and capital management. It's not a subsidy. And the value add for reinsurance to ownership, investors, etc., is strong profitability potential, the diversifying nature of risk, and a lean operating platform. So with profitability being important to both of those set of stakeholders, the current situation is just not sustainable. And I think that the reinsurance sector has a lot of value to add, and it will be unlocked, when pricing corrects and when we can really support the ambition of individuals and businesses, and we're on the right path, right? So demand is a notch higher, supply is flat to slightly stable. You have a lot of a different tone in the market about being more disciplined, and clearly there were a lot of data points at 1/1, but it's a start. And as an industry or as a sector, we need to keep going.
So, have you found? I mean, but how have you found that you're saying no a lot more? Is that just a simple fact?
I think that everybody has to build the strongest portfolio as possible, and there is pruning that is involved in the portfolio. I would say our story was more of working with our clients to get the right intersection. So at 1/1, obviously, like everyone else, or I can expect others had similar objectives. We wanted to drive rate. We wanted to build the strongest portfolio. Through that process, I really feel that we maintained very solid relationships with clients and brokers. And, one of the ingredients to that is strong communication, being early, being consistent, backing up what you say you're going to do. But we have credibility with our partners, and I found we were able to get to the right intersection. So it wasn't always about saying no. It was just about being clear, talking about needs on both sides, and ultimately getting to a place which worked for both the clients and brokers and also for us.
So you're sort of saying that clients actually respect a counterparty that is really clearly laying out its stall and saying, look, if you want me, you need to be around here because and that you're good at communicating that, and they want to work with someone who's going to be around for the long term. And is there a tacit recognition from them that they also understand that perhaps they've been getting a free ride on, or as you said actually before, a subsidy on their insurance perhaps, and that it needed to end?
Would say that clients respect long-term relationships, those counterparties who have credibility and have delivered, but the ability to have high-quality conversations. And when you're in front of a client, you show up. You talk about the real issues. I think, where the industry can fail is if you don't talk about the tough issues and your behaviors and your actions don't match some of the words that you have leading in. That leads to confusion all around. So I really believe communication's important. I think being disciplined and professional in the way you follow up is important. And, the way we measure that is in daily client interactions, but also we take client satisfaction very seriously. And that's a measure that we've institutionalized over the last couple of years.
And I suppose no one really wants a reinsurer who's not adding any value and is not really being a second pair of eyes on your own underwriting. And also no one really wants a reinsurer who's going to keep losing money year after year to the point where they're not much use as security to you.
Yeah, and I think when it comes to service offering and what you bring, your value proposition, some reinsurers may choose to be, a value-added provider in services or expertise, etc., and others may differentiate on agility and a quick response, and maybe others in price if they have a real lean operating platform. So I think there's different value propositions out there, and clients have to make a choice in terms of who they want to do business with.
Talking about rate acceptability, obviously you have to build your rate, and you build, you've got all your different costs and different models and other stuff. But of course, one key factor of that is your definition of how much profit you need to make out of the business that you're doing. Has that changed at all? Would it be fair for someone who's a buyer of reinsurance to say that you guys don't understand that perhaps in a zero interest rate environment, has the reinsurance industry adjusted its adequacy, its expected profit adequacy downwards, or is that just wrong? Anyway, I'd like to, do you think is anyone making a fair point if they believe that actually you don't need to make the kind of profits you used to before because no one does, because
I would
capital
argue with you that
doesn't return
over
what it used to.
a long period of time, the reinsurance industry has not made an impressive return, and in fact, many studies show that it's been well below cost of capital for many, many years. So I would disagree with the assertion that the reinsurance industry has been very lucrative and profitable over a long period of time, and therefore, the push to get better rate adequacy is undermined. But based on your question, a couple points I'd like to make. So I think overall, what's a simple number is just to try and achieve a double-digit return on equity, right? And we obviously want more than that. But again, if you look back in time, that's been kind of a difficult task. So I don't think that changes. Maybe the hurdle rate is higher. And then everybody has their own portfolio composition and which hurdle rates you want to assign to which lines of business. But one thing we always need to do as an industry is challenge our view of risk. So the calculation of our expected losses and our loss costs. And as you learn from losses and other risk factors, that by definition has to be adjusted. And the other thing you mentioned in terms of interest rates, when you look at business on an economic basis and you discount cash flows, interest rates are another ingredient or risk factor to determining what the right sale price is. So I think it is very relevant. And everybody measures deals and their portfolio in a different way. But I would say you can't ignore a low interest rate environment when you're trying to determine what type of margin you need on long tail classes.
Okay, I think that's probably enough about that kind of stuff. I think we should probably talk about you talking about your relationship with your clients, and we've got an interesting, very interesting renewal where I'm sure you're going to have some really quite difficult and deep conversations as your trusted reinsurance partner, Axis Re, with some of your clients out in Asia after loss creep on some of the Typhoon losses. And how are you going to start to go about that dialogue? Presumably, obviously, it's already a constant dialogue anyway, because of course you've got these claims coming in, so you're constantly talking. But now presumably is about the time you start really talking about the 1st of April renewals. How do you start that conversation with your customers over there?
So first of all, as you mentioned earlier in this conversation, there's been a lot reported on 1/1, so we don't need to go through that in great detail, but it was an improving market, and I think there's still a long way to go to get to the right level. And as you look to the remainder of the year, there's these 3 very big ticket renewals coming up because they're the markets that are most disrupted right now, which is Japan at April 1, Florida at June 1, and then U.S. Casualty, which can range anywhere from April to October. So in Japan, Japan's a very strategic market for us because it's a good market with good clients and a good buying culture, and we're invested. And, we increased our penetration after Jebi and Trami at the 2019 renewal. It's proven to be tough timing because, we had yet another record season, but we remain committed to that market. And I guess overall, we consider Japan to be very responsible and expect that the market will respond positively or in the right way to the loss activity that's been sustained over the last 2 years. I guess expanding on that, there is a need for substantial rate increases. I don't think that's a controversial point as we enter the renewal, but when you deconstruct why, the first thing that needs to be discussed is that everybody's view of risk, especially on wind business, will probably change because we have a more developed view of Typhoon Jebi, which will change your assumption of what type of return period that event is and will likely influence the calculation of the expected losses. So that's the first movement. And the second one is, clearly, we need a significant risk-adjusted rate increases, which would be the rate over trend. So I think that other perils may be impacted as well, but I think it's a market that will respond, but, it will be an intense renewal period over the next couple of months.
One of the features of 1-1 was perhaps a greater differentiation between good cedents and bad cedents, or better customers than others. Is that going to be a feature in Japan, do you think?
Well, I think for everyone that understands the Japanese market, I mean, there's a small number of clients, and I don't think it's comparable to the global market or some of the other markets. So I think the participants and the concentration and the dynamics are different.
So what you say, because there's such big players, it's much harder. You can't really pick a winner there, because if you've only got five or six really massive players that dominate the market, you're done. Then you really just need to play the market across the board. Is that the case?
Well, I think you have a mixture between very large, quote-unquote, mega PNC companies, and then you have a collection of mutuals, which are called kyosais in the Japanese market. But I think it's less about segmentation, and I think it's more about just evaluating what the right view of risk is, what's the right risk-adjusted return, where do you want your limits in terms of the portfolio you want to build, what's the right balance between different perils. I think it comes down to just classic portfolio management. And, as I mentioned earlier in this segment, that, we're committed to the Japanese market, we're committed to supporting clients, and, we'd like to grow in the right places. But nevertheless, we also have portfolio objectives and need to make sure that, we get the right risk-adjusted returns to make sure this is a sustainable proposition as we move forward. So
you're not cutting back or anything like that. You're not saying that what you've seen has sort of frightened you off or anything, in terms of some of these losses coming out far greater than the modelled loss would have suggested.
We are committed to the market and have faith in the relationships that we have and the clients in the market. Like I said, it's a good buying culture with good clients in a good market, and we remain committed. And we'll work together with our clients over the next 2 months. We'll get to the right answers together, and we look forward to being successful in that market over the long term.
Well, from one good market to another, perhaps a slightly more challenged insurance market. Is that fair to say? I don't know. Next time we go over there, maybe they'll remind me of anything I say about the Florida market. But it is far. Let's say it's probably chalk and cheese in terms of Florida versus Japan. You're talking about a state with many smaller players, all kinds of operations, large and small. Let's say some more professional than others. Is it much more of a stock pickers kind of market there? You need to pick your partners. Looking ahead to 1/6, and we've obviously had similar problems with loss creep, and of course all sorts of issues within the underlying insurance market with the assignment of benefits difficulties and other things. How are you going to go about attacking that market?
Well, I think you've already hit on the main points, and at the end of the day, I think that the key message is, yet again, you need meaningful rate increases. I think you need to emphasize selection, so pick your partners, and just every companies need to determine, what percent of their portfolio do they want in Florida, right? And some people are underweight and they probably want to increase. Others maybe the opposite direction, and I think that's a very individual choice. Just to describe the market, I mean, you could say it's dynamic. Certainly, disrupted, and it may even be dislocated by the time the renewal comes. I guess the big disappointment has been on the long tail phenomenon of cat losses. That's illustrated with the development of Hurricane Irma and others. And clearly there's instability in that market. And the reason why that's interesting is you take that instability and then you add it to the fact that this is a peak risk driver for most companies. It's a really fascinating situation. So, again, Florida is a part of our portfolio, one we expect to continue as we move forward. But, of course, we need to drive rate increases, and we have to emphasize selection, and that's going to be our mindset as we go through the renewal.
So is it just rate? Or would you stick up and say actually there are parts of this market that just need to change fundamentally, perhaps almost on a political level, before you can really be happy?
What I would say is, in order to be successful in certain markets, you need to have high certainty in your expected losses, which means when you price the business, you need to be able to be confident in some of the assumptions that you're making. And I think, you know, there's some non-economic risk factors that play, at least in the most recent past in Florida, and I think they're difficult to assess and difficult to price. So ultimately, you want to have as much confidence as you possibly can in pricing cat risk. And I think that it's one notch lower in Florida because of some of the characteristics that you mentioned with AOB and others. But it will still be a very, very meaningful part of the reinsurance market. It's a big part of our portfolio. That will always continue. But again, it's going to be an interesting renewal where I think, similar to Japan, although completely different market, it needs a bit of a correction.
So it's almost like if you write property cat, you have to do Florida, whatever happens, however happy or unhappy you are, because it's such a large piece of the pot, you can't miss it.
I wouldn't say that, and I think there's plenty of companies out there that don't feel pressure that something has to be a part of your portfolio. I mean, I think everybody wants to build the portfolio that's going to deliver the best results for them, and we all have different criteria that base an optimal portfolio. So, look, I think the situation in Florida is still unfolding. There's a little bit of time before the peak June renewal period, and we'll take it step by step.
Steve, before we move on to talking about Casualty, which is the next of the trio that we're going to be talking about, for the interesting renewals of this year, one fact I haven't asked you about was the retro. While we're still talking about property cat focused renewals, what about the effect of retro? We had the collateralized ILS backed collateralized retro market sort of disappearing or being locked up at the last renewal, certainly affecting pricing in a meaningful way. Did that affect you as a pure reinsurer? Did that affect your strategy going forward into 1/1, and how is it going to affect your strategy going into 1/4 and 1/6 as well? How much are you sort of driven by what's happening in the retro market, or do you just take it or leave it?
So a couple of points there. So one is the advertised hardening of the retro market is real, and we see it because we also write inwards retro. It's small portfolio, but we saw it there, and we buy outwards retro, and so I think those rate increases are factual and they're real. So that's point number one. Point two is we run our portfolio on a gross basis. So we buy retro, we have partners, we use third-party capital, and that's been part of the Axis story for several years. But we build our portfolio and we execute on a gross basis. And therefore, reshaping curves and upscaling in some markets and reducing in others, that's part of a gross portfolio strategy. And we work side by side with partners who have fully aligned interests, who participate in supporting us, not only in our cat book, but in other lines of business as well. So I would say any of the adjustments that we've made or decisions have been in what's in the best interest of our gross portfolio. Clearly, we want to make the best return for our strategic capital partners, and we feel like the interests are fully aligned, and we feel really good about where we are there.
So just in that sense, would you be writing a little bit more of inwards and buying a little bit less outwards, or is that fair to say? Or?
I would say that would be over-interpreting. We manage the aggregations and PMLs at a bit of a higher level than that. There was no specific strategy as such when it gets that granular. But at the end of the day, we're trying to build the best portfolio that we possibly can and achieve the right cat curve for Axis.
As someone who's sort of really across the board and very close to capital and always has been, What's your sense of some of this trapped capital? What's going to happen to it if it becomes untrapped and gets released? Is it likely to be redeemed by some of those investors who might say they've had enough of this investment, or is it going to be redeployed, and is that going to affect the retro pricing all over again and it start to go down again?
It's a good question and hard to speculate. I would say, based on our conversation earlier, regardless of the trapped capital situation or not, I do expect that supply overall, both traditional and alternative, will be rather flat, maybe a notch down, in 2020. And I expect demand to be slightly elevated. I mean, Artemis did a survey, as they do every year, and they asked the community who wants to buy more, who wants to buy less, etc., and which I thought was very interesting. It was about 6% of the population said they were going to buy less. 50% said they were going to buy more, and the balance said, kind of about the same. And we certainly felt that at 1/1, and as we talk to clients now, that there are more needs in terms of earnings volatility or trying to protect income statements and balance sheets. And so I expect demand to continue to be at a very strong level. By the way, protection gaps are still massive. And we project demand in reinsurance to steadily increase over time, maybe 3% per year from 2019 to 2021. So, there's still a very strong need and a very strong relevance for reinsurance. It's just historically has been strongly capitalized. And I think these trends in terms of price equilibrium increasing because we have a global profitability issue will continue.
Right. Let's get on to the casualty question, which I think is probably the most interesting one, because it's such a long scale, long-term cyclical market, which seems to be showing signs of certain signs of turning and of stress. How much? How comfortable are you with what's your take actually, just on the casualty reserving situation? Do you think we're heading into a very large? Do you buy into the old reserving cycle, and are we now entering into a period of reserve inadequacy and a period of many years in which most people's results are peppered with reserve increases in reserves and provisions for prior years, rather than reserve releases?
I think it's hard to generalize across the market. I think that story will be individual to different companies in terms of what their portfolios are, where they decided to play, what was the adequacy of loss picks, how conservative or aggressive were you in setting reserves. So it's very difficult to generalize across the broader market, but my hypothesis is that there will be pain felt in the industry, and it all depends on what your practices were leading up to it. But just on U.S. casualty overall, I think the big challenge is, what are your cost of goods sold moving forward? So we know that we live in an industry, we're one of the only industries out there, if not the only one, insurance, where you don't know your cost of goods sold. And I think this is even more amplified with U.S. casualty at the moment, because we all know that casualty is a social science. Okay, property is a natural science, and in a social science, it comes a lot down to behavior. And when you have non-economic risk factors, so you're not talking about wage inflation, you're not talking about medical cost inflation, you're talking about social inflation. And I think the hard thing is, how do you assign the right loss cost to that risk as you move forward? So rates are increasing meaningfully, both on the primary side and starting on the reinsurance side. And I would say that soft market commissions need to be adjusted. But the combination of the two looks quite impressive at face value. But every company needs to challenge themselves in terms of what is the expected loss for those individual transactions and those portfolios. And I think that will ultimately come down to everyone's posture, whether you want to grow, whether you want to retract, or keep something fairly moderate.
And as Axis, you've got a very big casualty arm on the insurance side of your business. Is that you're able to kind of get some of their data and help analyze that? And also, The other main question would be: are reinsurers driving some of this hardening in casualty, or are they just being happy to go along for the ride with the primary side of the insurance market is actually fixing itself, and the reinsurers are just getting a free ride along?
Okay, so
rather than being the ones to push it.
Yeah, a few thoughts. So first of all, yes, we have an access insurance business.
Which is well known for being a casualty leader.
But what I would say is my observation, being with the company for a little over 2 years, is my belief is that business and those underwriting teams have managed the cycle well. So I think they've been very proactive and maybe a little bit early detecting some of these trends. In terms of sharing information, everything we do across insurance and reinsurance is within the legal boundaries of what is possible,
right? Of course, Steve.
And no, I say that because I think when you're a hybrid company, our obligation to our reinsurance clients is to make sure that we do business with them and we don't share information when it's not appropriate. So maybe it goes without saying, but something that's really important to us because we really respect the relationships that we have with our clients and want that to be a very long-term proposition. Access is a hybrid model. So one of the beauties of the hybrid model is not only do you gain insights on what's happening on both sides, but you're able to steer and manage a portfolio. And I would say I believe we've managed the cycle well on both sides. But we have to continue to observe and get some experience in terms of what is going to be the profitability of the casualty market in the most recent underwriting years, and we'll make our decisions accordingly. I think right now the best thing we can do is to achieve as much primary rate as possible in the insurance business. And also keep an eye on very proactive portfolio management, which is something I've talked about a lot during this conversation. On the reinsurance side, when you do participate in pro rata treaties, you get the benefit of primary rate. I think those soft market commissions that I mentioned definitely need to be addressed. But similar to the conversation we had in Florida, even though they're fundamentally different situations here, this whole idea about segmentation, selection, and picking your partners also applies.
So the message is we need to go back to some of the. This is on the proportional side. We need to go back to some of the ceding commissions that we were seeing before the market really softened.
Yeah, one size doesn't fit all. So every treaty and every client relationship is different. I would say is there's definitely a need for rate. And the key message I would say is you don't know your cost of goods sold. So everybody's going to have to take their own view of risk, and it's complex because of these non-economic risk factors that are at play.
I had another look at Q4. Sorry again, obviously perhaps not the most representative quarter and a bit of a small one, but I noticed actually in there something that we're all looking at expense ratio that two of your acquisition costs and your own administration costs were moving quite sharply lower. Actually, was there anything? Is that the taste of things to come for the rest of 2020, or is that just reading too much into one quarter again?
So I would say that we have a big emphasis on remaining lean as a reinsurance operation. That's something that I'm very proud about, and I think that the business does well. So we have expense discipline and control, and I think that will continue. Acquisition expense is hard to interpret because many times it is a function of mix. And mix in one quarter could have misleading conclusions. Nevertheless, I'm not trying to undermine the message. I mean, we need to, on pro rata treaties where it makes sense, adjust commission levels. That's all part of this whole, pricing being sustainable over the long term. There are probably plenty of treaties out there already that are set at the right level, so this is not meant to be too broad of a statement, but absolutely this is a lever and it's in the conversation. It's not just about primary rate. Reinsurance rate on pro rata treaties also is part of the equation.
I want to talk more about market dynamics in the sense of, let's say 3 years ago, you could talk to any reinsurance broker and they'd say, okay, there's a consensus on pricing. If I hit this price, I can this placement will sign 200. This will be overplaced 200-300%, and I'll have a massive headache trying to sign it down because everyone will say yes. But below a certain level, everyone will say no. But now, how much more differentiated do you think the marketplace is in terms of less? Do you think there's less agreement on what is the right price these days? And do you feel that anyway is Axis sticking out one side or the other, or do you think you're down the middle?
Well, brokers tell us we're the most expensive, of course, but no, that's a joke. So, what the only data point I can give you or observation is, I think the era of oversubscription seemed to have come to an end. And speaking to some of the larger broking firms, they have good statistics on this information, but nevertheless, at 1/1, particularly at the last couple of days of the year, I mean, it was obvious that certain programs were short. And there was a lot of pressure in the market to finalize placements. There was firm ordering of terms, which obviously tells you something. But I think programs got there in the end, right? So that's why when I said 1/1 was a good start, I do think it was a good start, but I think we're far away from dislocated conditions. So I wouldn't oversell it as, a very hard market. But nevertheless, I think that trend is probably over, and everybody has their own view of risk, which formulates a different price at the end of the day. So without data in front of me, my assumption or my observation or hypothesis would be that there was probably a wider range of prices recently than what you have seen in the past.
Well, I hope you not think that I'm being sycophantic by saying that Axis has always been seen as a quality player, as quality security to have to buy into. Do you think that there will be? Is there any kind of flight to quality likely to happen? As we have fear at this stage of the market when if people are worried about. I suppose it's a general trend that if you can't be sure of what your Florida hurricane numbers are, what they're going to end up being, you can't be sure of what your Japanese typhoon numbers are, or we're going to end up developing into, and you can't be sure of what the casualty situation really is on your live, on the book that's still running that you've written in the last few years. There's also a question about can you believe the numbers from a cedent side, and also can a cedent really, it's also a time when quality cedents tend to re-rationalize some of the reinsurance security that they've been using as well, and hoping that it's going to pay out and it's not going to be a reinsurance recoverable that stays unrecovered. So I'm just talking about in general about quality. Is that a situation you're kind of looking forward to, or you're kind of thinking maybe it's payback time for Axis?
Well, as I mentioned earlier, I mean, being client focused and making progress in that direction is a really big part of our strategy. And there's this kind of mentality in the market historically that if you're going to drive improvements to your portfolio or help be a part of the market solution on pricing or terms or whatever the case may be, that you are doing it at the expense of being client focused. And, what I'd like to share is I think both are achievable. And we experienced that at 1/1, and we're going to continue to be very tenacious in terms of being visible in front of our clients, to make sure that the conversations are of high quality, the relationships are of high quality, to make sure that we communicate effectively, that we deliver on what we're going to say, that we're very professional in the way we follow up, and that we have high client satisfaction. And what we've experienced and what I strongly believe is if you're able to manage a client relationship in that sort of way, even if you need to have a difficult conversation, ultimately you can retain or even improve the strength of your relationship. So I don't think it's a digital choice to say, is your risk appetite, changing, yes or no, and therefore what's going to happen in your client relationship. We remain very confident that we're going to be able to be a part of the industry solution, but at the same time continue to build our client franchise to one that's very successful.
So you're saying you can really, that you can have those difficult conversations with clients, even if they're long-standing clients, and say, sorry guys, we do have to charge more. But I suppose you're relying on that good communication that you've had over the years to be able to say, here's why, and that they'll definitely
Yeah,
believe you.
look, you don't need to be one-dimensional, right? You can be multi-dimensional, and I think honesty and facts and good finesse with clients is never a bad thing. And I think they help you manage through these times. And I'm proud of the balance that we're building between retaining the technical aspects, being good portfolio managers, but also having a strong client franchise. And we see dividends paying off there.
Well, Steve, actually, you seem very relaxed. So I can only commend you that you don't seem fazed by any of these market difficulties, and you seem to be relishing these difficult conversations that you're going to have to be having over the next 6 months.
Look, you don't relish in difficult conversations with clients, but at the end of the day, if you want to run a successful business for the long term, it's necessary. And we continue to invest in our platform, trying to attract the best people, trying to bring energy to the market and to the conversations, and our teams are highly motivated, aligned, and determined. And I think, if anything else, that's going to give you the best chance to succeed.
Well, I've run through most of the questions I wanted to ask you, Steve, and we're coming up to a reasonable amount of time spent together. Is there anything that you think we haven't spoken about that we should have done?
Well, maybe what I'll do is just elaborate on that aspect I was just talking about on the team and the need to continue to be people focused. So we have a belief, and I have a belief, that highly engaged employees lead to highly engaged clients, which ultimately will lead to growing profits and better returns. And I think it's so important, even as the market goes through a difficult period, to live these principles of making people feel valued, a sense of belonging, and a greater sense of purpose. And I know that sounds cliche or very basic, but it's very important to stay focused, because I think on a day-to-day basis, it becomes difficult to implement when you have portfolio objectives and the market needs to correct in a certain way. So we're really committed to having a human culture and trying to exhibit as much emotional intelligence and EQ as we possibly can. And again, as we talked about earlier, I think really being transparent and having strong communication is the key, and being honest. And it sounds easy, but it requires commitment and a huge difference. And I just want to say that we're so proud of the team that we have at Axis across both insurance, reinsurance, and some of our corporate functions. And we're pretty confident in the future.
And suppose, and that's how you differentiate and compete in a world in which a lot of people see reinsurance capital as just a cheap commodity.
Yeah, and then ultimately, if you invest in your people and you're good with clients, these sounds like some of the softer factors about client relationships, investing in your people. But when you match all the harder aspects of what we need to do in our industry, I think it makes a difference.
Well, thank you very much, Steve. I think thanks for your hospitality, and good luck with all the renewals. As I said, and we'll come. Obviously, I'll book in some time with you at Monte Carlo, if not before, to check in to see how it's all gone.
All right, thanks, and good luck with the podcast.
Thanks very much, Steve. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.